Good afternoon and welcome to BizTech's Asian Midday Market Watch. Our guest today is Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank in Singapore. Now, Vishnu, thank you very much for doing the show despite the fact that you've just tested positive for COVID.
My pleasure. No better way to start the Monday. I meant the show, not COVID.
Now, before we get your insights, Vishnu, let's take a look at crypto markets and then take a look at regional stock markets. Bitcoin is now at 23,344.3. It's up 1.7%. Ethereum is at 1,712.75. It's up 2.25%. Looking across the regional stock markets, the Straits Times Index is down 0.63%. The KLCI is down 0.56%. The Shanghai is up 0.18%. The ASX All Ordinaries is up 0.07%. The Nikkei is up 0.28%. The Hang Seng is down 0.63%. And rounding up the numbers, we've got the Kospi, which is up 0.09%. Vishnu, pretty mixed bag. Tell us why.
But I mean, it does look like markets have forced to reassess. Just to recap, after the FOMC, markets for some reason read the whole climate as the Fed ready to step down and pull back from aggressive hikes. This was not our view. The markets went along with those views, and so we did see USD yields dropping off, the dollar becoming weaker, some extent of rally in the markets, but that has quickly now turned around with very, very strong US jobs numbers, and the Fed speak also coinciding with that, suggesting that they remain laser focused on inflation. That's to say, they're not going to step back from tightening and rate hikes. And in fact, I think they're keeping the option of a 75 basis point on the table. So in simple terms, from markets hoping that September FOMC will be a question of 25 or 50 basis points, they are now coming to the realization that it's more likely it remains a question of 50 or 75, which means the Fed is still aggressively hiking. They may also double quantitative tightening, so the pace at which they drain US dollar liquidity to 95 billion a month. And these things usually coincide with much higher yields, a stronger dollar, both of which tend to knock and dent EM markets. And I think this time around, what's also happening is, despite a hawkish Fed, markets are also increasingly worried, and it's not just despite, it's because of the Fed maintaining its very aggressive stance on inflation. Fears are concurrently growing that you get into a recession, and that's why you're seeing commodity come off, and commodity currencies also, having a very bad showing, and that's where we are. We're at a stage of binary risks. Either we get into inflation not being anchored, but in the process of anchoring inflation, higher chances of a recession risks, which have showed up in a more deeply inverted yield curve.
Now, so here's the dichotomy. It's very clear that in Europe, they're in for a deep recession. But the signs are not beyond the inverted yield curve. The signs are just telling us the opposite in the US.
Absolutely. I mean, you get jobs numbers. The jobs created was more than double at over 500,000. You have unemployment continuing to fall, and wage gains continue to be much more rapid than anticipated. And so the Fed is, as things stand, even if inflation peaks out, if it comes back below 9%, the Fed cannot dial back proportionately how much tightening is going to do because of the wage price spiral risks. So there are aspects of the US economy that's strong, but equally, you also see signs in the ISM that there are soft spots starting to emerge. So as you rightly point out, the trouble is the dichotomy, where it's not just across the Atlantic, even within the US, there's a dichotomy between soft spots in the market, but not being able to take their eyes off the inflation ball, which is reminiscent of previous experience where, rate hikes have led to recessions. And I think that's what markets are fretting now.
And so then I want to bring another bit of data that's closer to home, which is China. So now, over the weekend, China reported trade data for July, and it showed that US dollar dominated exports grew about 18% compared to a year ago. Now that's the fastest growth this year, and it beat analyst expectations. The number that they expected, according to a Reuters poll, was something like 15%. Now, another set of data, China's dollar-denominated imports increased 2.3% in July, lower than the expected 3.7% gain. So closer to home then, we have this data from China that, while on one school of thought saying that China is going into a period of slower growth, some of the data, well, as you always say, backward-looking data suggests that the slowing growth is not slowing clearly enough.
Yeah, I mean, that's certainly something we need to think about if we sift through the data. But the trouble with the data is you've had all these disruptions and distortions along the way. So you have supply chain disruptions, and then that kind of catch-up data, and you also have the price effect, because the data we see are based on prices going higher as well. So it's not entirely about higher volumes of exports being enjoyed by China. In some cases, it's just a price effect where more expensive exports are headed out. So part of it is inflation effect. Part of it is supply chain disruptions that lead to a lot more disruptions. And as you rightly pointed out, the US hasn't clearly shown signs of slowing down, across the board either. Whereas that's where the demand for Chinese goods are coming from, where the rest of the world are still, looking at upping levels of inventory, where there needs to be, or due to the supply chain disruptions earlier, they had some shortfall and deficit. But an interesting point to note is China's own imports suggest to us that there's some degree of caution and inventory drawdown that allows them to substitute away from fresh imports. So that could be the giveaway about the caution, where they don't want to import in a big way and build up inventory because they see their order books not looking as strong if you go down, say, 18 months.
And it's interesting you said that, Vishnu, because last week I spoke to a chief operating officer of a large semiconductor company listed in Singapore, and that's exactly what they said. Basically, you see the narrowing in terms of inventory buildup. In fact, people are starting to draw down on inventory, and so therefore the tightness in the market, especially in the semiconductor space, will probably ease up and has already quietly starting to ease up already. So those are things that we could, again, semiconductors is an example of an industry that has a boom-bust cycle. And I think that's where the supply chain constraints will then start to open up, I think, as demand kind of falls a little bit closer to supply.
Yeah, I totally agree with that.
Now, Vishnu, looking ahead, what are you looking at this week in terms of key data and events that will move markets?
Well, I think, in the region, we are getting Malaysia's GDP, Philippines GDP, Bank of Thailand, where we decide, or we really want to watch where the Bank of Thailand finally, with a leg, starts lifting its rates and getting in step with the other central banks and all. So these are all the interesting things to watch. But really, the overriding data that all of markets will be watching will be US CPI. So after the jobs data, the question is whether US inflation indeed peaks. The expectation is it comes back below 9%. So they're expecting some peak, but the bar is high for them to dial back on what the Fed may do in terms of tightening, because it needs to come down substantially and for a sustained period of time, which is not likely to come through in the data this week. So expect some volatility and upside bias in USD yields and the dollar.
Now, Vishnu, as always, thank you very much for your insights, and thank you very much for coming on the show.
My pleasure, Brian. Thanks for having me.
Now, we've been speaking to Vishnu Varathan, Head of Economics and Strategy at Mizuho Bank, on BizTech's Asian Midday Market Watch. This video and podcast will be on our various platforms, as well as our website, www.biztech.asia. Please like and subscribe to our various platforms. Thanks again for tuning in.